Is the commercial real estate sector in distress right now? And what will happen to the housing market now that the Fed has cut by 50 basis points with more rate cuts expected on the way?
We expect there to be big losses in the commercial real estate sector. But my experience in the financial crisis of '08 is usually there are surprises on where those losses end up.
Willy Walker joins us today. He is the CEO and chairman of Walker Dunlop, a leading and prominent commercial real estate finance company in the U.S., listed on the NYSE under the tickers WD. Willy, good to see you. Thanks for joining the show.
My pleasure, David. Nice to be here.
So, Willy, according to some economists, the commercial real estate sector remains at risk and poses a threat to the financial sector overall, given how exposed regional banks are to CRE. Take a look at some stats here. According to S&P Global Intelligence, in one of the recent research reports dated September, the delinquency ratio for commercial real estate CRE loans across U.S. banks rose 16 basis points in the second quarter to 1.4%. Is this a concerning stat for you?
So you just used a number 1.64%.
1.4%, yeah.
Yeah. You remember where that was in the Great Financial Crisis?
I don't know off the top of my head. Please tell us.
North of 8%.
Okay.
So, yeah, I think it's important. Are there issues in commercial real estate today? Certainly. Are there office buildings that are impaired and don't really have a path to the future? 100%. But to talk in generalities, commercial real estate is doing very well. To talk in generalities, it's odd to have a stock market at an all-time high, to have bond yields that have settled down to what historically would be very normalized or affordable prices, and yet we've been in a low interest rate environment since the Great Financial Crisis that has made many borrowers think that the long bond ought to be down with a 2-handle or a 3-handle on it. So having a 4-handle on it makes it feel elevated. But at the same time, you go back to just pre-Great Financial Crisis. For the 3 years before going into the Great Financial Crisis, the 10-year Treasury stood between 4 and 450 for 3 years. So, and that was a very robust economy. And so I just think it's important for people to remember that while clearly if you had a floating rate loan on a commercial property that you bought at a very, very low cap rate in 2021, that's not performing very well today. But that doesn't mean that there is a crisis going on or that commercial real estate writ large is a challenged asset class.
Is the trend of delinquencies on the rise, though, Willy?
No, I think we've hit peak delinquencies. I think we're on the other side of that. I think that you're very clearly, if you look at the CMBS, commercial mortgage-backed securities data from August, David, basically the delinquency rate stayed flat across all asset classes. And what you ended up having was certain new additions to it, but then also loans getting cured where there's either an extension or the loan's been paid off. And so in August, we basically stood still as it relates to the delinquency levels. It's my assumption with rates coming down that delinquency levels continue to come down.
Okay. Let's talk about the Fed now. The Fed cut by 50 basis points. How do you expect this cut to affect different segments of CRE, namely retail, multifamily, hospitality, office, and so on?
You got to keep in mind that 75% of commercial real estate assets have fixed rate debt on them. So only 25% of the market is impacted by interest rate movements like we have seen over the last month. I think the second thing to remember is that at some point we need to get to a normalized yield curve. So we've been in an inverted yield curve, which one of the main reasons so many people called for a recession is that an inverted yield curve has almost been a perfect precursor to a recession. And so everyone who bet on us going into a recession over the last 2 years was basically looking at history and saying, when you get an inverted yield curve, we're going to go into a recession. That has not happened. And interestingly, what we have right now is we have bond yields going up at the same time as equity returns are going up. You've got the S&P and the NASDAQ at all-time highs. And at the same time, we've also seen the 10-year move over the last month from a 362 up to, it was at 409 yesterday. I think it's rallied a little bit today to 404. The bottom line is that's a very odd occurrence, because typically when the Fed cuts by 50 basis points, that means that the economy is going into recession and they're trying to head that off by easing. And in the process of doing that, people would fly to safety and therefore buy a 10-year treasury. That has not been the case since they did that 50 basis point cut. We've seen the equity markets go up and we've seen bond yields go up, which means that there's been less capital going into fixed income. What does this all mean for commercial real estate? It's a capital intensive business. Most of our loans are 60 to 70% loan to value. So when someone buys a commercial asset, the debt markets are extremely important to making that work. And so when the cost of debt capital goes up as significantly as it has, that's going to slow things down. What we will see over the next year or two is as rates come down on the short end of the curve, long end, which is what really drives financing cost in commercial real estate, should stay around where it is, maybe come down a little bit, but that will provide for buyers of commercial real estate to understand what they're buying and what their financing cost is. That will drive more capital to the sector, and that will bring cap rates down or values up. And so at the end of the day, this rate cut is very important because it will begin the next cycle in commercial real estate. And we should have a 2 to 4 year period here where we get really, really good movement as it relates to volumes as well as values on commercial real estate.
Before we continue with the video, I want to take a moment to tell you about today's sponsor, Caleb and Brown, a crypto brokerage where you can buy, sell, swap, and safely store your crypto assets through your own dedicated broker. Caleb and Brown is customer service obsessed, validated by hundreds of reviews on Trustpilot and Google. Each customer has their own broker who they can talk to about their crypto portfolio and get the latest insights on crypto trends and news. If you're time poor and don't want to risk your capital by navigating several exchanges, then a premium brokerage may be the best option for you. Caleb and Brown offers a bespoke service to figure out your exact needs. They offer over 300 coins with thousands of pairs while ensuring 24/7 real human support is available. Much like private banking, the service is tailored to your needs, and there are no support tickets and no withdrawal maximums. There is no cost to sign up and speak to the team, so use the link down below or scan the QR code here to get started. The other trend that's happening concurrently with the Fed cut is the return to office trend. A lot of companies are now mandating workers to spend more time at the office. I don't think this is due to the Fed cut. This has been happening before September. What does this mean for demand for CRE?
So I'm pretty bullish on office. I think that I'm kind of there are not too many people who are bullish on office right now. The numbers would tell you that office is still a very challenged asset class. But I think, David, to all the points that you just made, I think employers are starting to insist on people coming back into the office. I think that you think about the U.S. economy. We're a service economy. I think manufacturing is 8% of our workforce today. The majority of companies in the United States are service businesses. That means those are people engaging with people. They're not hard assets. They're not manufacturing widgets. They're either writing software that's going to be sold to someone. They're providing a service to them. So if we're a service economy, what is fundamental to the growth of a service economy? Humans interacting with humans. And so I think that we will see office rebound. It's not going to happen overnight, but I think we are definitely at what I would call a tipping point as it relates to, we've been basically stagnant on back to office numbers as it relates to what percentage of the workforce is actually back in the office. I think we will start to see more and more people coming back to the office. And I think we will see employers starting to make it more and more of a demand for the people that they hire.
Does history give us any clues as to whether or not the market would favor buying versus renting in a declining interest rate environment?
So if you look right now at the cost to own versus the cost to rent, there is a massive gap. And there are two reasons for that. It's much, much, much more expensive to own today than it is to rent. And the reason for that is the cost of single family housing has gone up dramatically. It's gone up 53% in the United States since 2019 to 2024. So pause for 2 seconds. If you are a homeowner with a fixed rate mortgage on your home, you are benefiting fully from likely your largest asset having appreciated 53% on average over the last 4 years. So everyone talks about housing affordability and how it's some big crisis in the United States that homes have appreciated so much. That's only the people who want to buy the homes and can't afford to buy the homes. 65% of the American population owns their home. 65%, 35% rents. So all the conversations about home ownership being so difficult to get into, that's looking at the 35% that rent today and not the 65% that actually home. But to that, there is a huge delta between renting and owning today because of the cost of housing going up so much. And as you say, because interest rates are so high. So the bottom line is you need to see movement on both of those. You need to see the cost of the average home come down. That's the only way to get to that is more supply of both single family and rental housing. And the other is to see interest rates come down. The single family financing market is typically or home sales market, excuse me, is typically 90% existing inventory and 10% new inventory. That's historically the way it has been. In other words, it's people selling the homes that have already been built and lived in and reselling them to somebody else. Today, it's 70-30. Only 70% of the single family home sales market is existing inventory and fully 30% is new supply. That's just because people who have trapped in low mortgage rates don't want to go sell their home and go from a 3.5% fixed rate mortgage to a 6.5% fixed rate mortgage. Just doesn't buy you as much. So people are somewhat trapped in their existing homes, and that's making so they're not putting those homes onto the market, and that's making the cost of housing continue to go up.
Well, speaking of housing affordability, you've actually written about this issue on LinkedIn, for example, highlighting the fact that housing affordability is now a major election issue. Now, we're speaking ahead of the election, according to many different think tanks, including the Joint Center for Housing Studies at Harvard. The affordability issue has become a lot worse. So take a look at this stat. In 2022, the median sale price for a single-family home in the U.S. was 5.6 times higher than the median household income. This is higher than any point in the past, including all the way back to the 1970s. Willy, do you see in any scenario this trend reversing back to the historical average?
Well, if Kamala Harris had her way and had us build 3 million homes in a year, yeah, you'd see it come crashing back down. The bottom line is that we're not going to build 3 million homes in 1 year. But her proposal to increase supply is the only way you deal with this issue. So you're not going to deal with it in any other way. Subsidies to first-time home buyers, all you do is put that into the cost of the house. So that doesn't do anything to make pricing come down. Incentivizing home builders to build more affordable housing, they need to have the entitlement process reduced, and that is at the state and the county and the local level. So that's not a federal government issue. That's a local, state, and county level issue. But if you can get that reduced, home builders will build homes up and down the economic spectrum. The problem is that it takes so long to get land entitled that home builders go and build a house that is at the highest margin they can get, which is typically between $500,000 and $600,000. And so they're building homes. A $500,000 to $600,000 home is not affordable to someone making the median income in America. You want them to be building $300,000 to $350,000 homes. That's affordable to someone making the median income in America. But the only way to do that is not to incentivize them to build a $300,000 to $350,000 home. It's to make the entitlement process quicker and easier so that they have tracts of land to develop, and then they can develop across the spectrum of housing prices. So I do think that we can see real movement on this. And the only thing that I would say, David, on it that we have to be very careful of is remember, President Bush was elected in 2000 with a home ownership theme to his campaign. And President Bush pushed it very hard. Home ownership in America. He wanted to take the home ownership level from the low 60s, 62%, up to 70%. And guess what? He started to achieve that goal at 70%, but because we built so many single family homes in 2004 and 2006 and 2007, we all know what ended up happening on the backside of that, which was the great financial crisis, which was largely caused by too much supply of single-family housing, and then clearly the mortgage side to it all, where people were writing mortgages that they should have never written on the homes that were being built.
And when Kamala Harris said that she wants to build 3 million homes.
So we are going to cut red tape and work with the private sector to build 3 million new homes by the end of my first term.
What does that mean exactly? Is the government going to spend money and actually directly build these homes and then later sell them to the public? Will they provide initiatives for developers? Like, what does this actually mean in practice?
So the two pieces are put out there 3 million new homes as a target. We're right now building around 1 million new homes a year. Between multifamily and single family, the single family numbers have gotten as high as 1 million new homes in a given year, but that's now in the high hundreds of thousands, 800, 900,000. Multifamily this year has had the highest deliveries of any year on record. We've had 425,000 multifamily units delivered into the market this year. You deliver 425,000 units of multifamily into the market, and that brings prices down. There's not an owner of existing inventory that doesn't sit there and look at 425,000 new units to the market and say, my rents are going to either come down or stay flat. But I don't have the ability to push rents in markets that have that much supply coming on. So what we need to do is make it so that the entitlement process for land is accelerated. And then what Vice President Harris is saying as it relates to her policy is to give first-time home buyers a $25,000 subsidy. As I said previously, that's foolish. All that $25,000 is going to go into the price. So if it was a $300,000 home, it's now going to become a $325,000 home. If it's a starter home and everyone bidding on it is a starter. And then the other is they want to give incentives to builders to go build affordable housing. And as I said previously, you don't need to give the incentives to the builders. You just need to have the entitlement process go quicker. And if you did that, you would have land being entitled and builders being able to build across the economic spectrum.
Okay, and she also promised to provide first-time home buyers with up to $25,000 to cover the down payment.
So in addition, while we work on the housing shortage, my administration will provide first-time home buyers with $25,000 to help with the down payment on a new home.
What would that do?
Just move housing prices up. It's bad policy.
Okay,
But by the way, she at least has a housing policy. As I said on CNBC a couple of weeks ago, the Trump administration's housing policy right now is to work on mass evictions of people from the United States and deport them back to their home countries. And in the process of that, free up housing. Last I checked, there weren't too many illegal immigrants who are signing leases in the United States or on the title of a home in the United States. So I'm not sure how much that helps. The second thing they've talked about is the spinning Fannie and Freddie back out and making them public companies again. Fannie Mae and Freddie Mac play a huge role in the housing finance market, and I'm fully endorsing of doing that. But that's the extent of the Trump campaign's proposal for housing. I would love to see them, and I don't count on it over the next 3 weeks, see them come out with a more articulated program that talks about what else they would do to try and spur development and the supply of housing to then bring down the cost of housing in America.
Well, just on that issue, I think it's because they have different platforms for bringing down inflation. Trump wants to focus on the energy side, Kamala on the housing side. Will housing affordability, if it were solved hypothetically, would that help with inflation overall?
Well, sure, because right now inside of the CPI print, as well as the PPE, but more on the CPI, housing is 36% of the index. So you see rents come down, you see housing come down, and your CPI print is going to come down significantly. The issue with it is I think the Fed has looked through that. I think the Fed understands that that's a lagging indicator. And they also understand that owner equivalent rent, which is how they calculate the cost of single family housing, is not only antiquated, but a really, really bad way of calculating what the cost of home ownership is. So I think they're looking through that right now. If they weren't looking through it, I don't know that they would have done a 50 basis point cut in their last meeting. And so clearly we can bring the cost of housing down and that will impact inflation. But the one other thing, David, that you talked about was energy. I think it's really interesting on this one, because if you go back to the debate between Trump and Biden, Trump crushed Biden on energy, saying drill, drill, drill. If Biden had been briefed properly, he would have known that no nation on earth has pumped more oil than the United States pumped in the month of July. We pumped 13.3 million barrels of oil a day. No country has ever pumped that much oil. The United States and Canada, in the month of July, the two of them pumped more oil than all of OPEC. So we didn't need the pipeline to make it so that the United States and Canada could actually become the world's largest producers of oil in July of 2024. So it's really interesting because I think that the political narrative is one thing. The actual numbers on the ground are very different. And I will commend President Trump for seizing this issue and making it seem like he will be very good for energy. The bottom line is that right now, the United States of America is pumping more oil than we ever have historically.
On the shelter component of the CPI, let's just take a look here. So you're right, it's been trending down. The shelter component, which is owner's equivalent rent, is now sitting at 4.9%. Is this downward trend going to continue, do you think?
No doubt. No doubt.
Okay.
Has to. With 425,000 new apartment units and rent is of the 36% I just said, rent is, I think, 9% of it. Single family housing is 27% of it, and rent is 9% of it to get to the 36 or 37. As rents continue to come down, you'll see that happen because there's so much supply in the system. And then the home builders are building plenty of homes. And so I think that we also have seen some softness in the single family housing market, and that will bring rents down.
Historically, what have been the primary drivers of rent, either up or down?
Supply and demand.
And all right.
At the end of the day,
Econ 101.
It's supply and demand. And if you don't have enough supply, prices are going to go up. And look, we had huge problems during the pandemic as it relates to supply chains. So builders couldn't build what they wanted to build. And oh, by the way, in the pandemic, everyone also wanted to move out of multifamily into single family because they wanted to get away from COVID and they wanted space to be able to work from home. And all those different drivers got into a point where we had this massive spike in the single family housing market. Couldn't get enough supply and demand went through the roof. Things are normalizing. Cities are back up and going. You look at office occupancy in some of the major cities where Walker Dunlop has offices. People are back in the office. They want to live close to where they work. They want to go out and do things. We lost all that for a period of time. Living in Greenwich, Connecticut seemed like a really, really good thing to do in 2021 and 2022. Remember, Greenwich was dead, literally dead. You couldn't sell a mansion in Greenwich, Connecticut in 2019. You could not. Prices came crashing down because everyone was like, no, I want to be in the city. I want to be where the action is. I don't want to be in the suburbs. That all turned on its head. I think we're getting back to a more normalized market.
Do you think that developers are going to prioritize multifamily over single family going forward?
They're two totally different worlds, David. Two totally different worlds. There are some home builders who are in the multifamily space. So D.R. Horton being one of them, Lennar being another one, where they build single family homes and then also are significant players in the multifamily industry. But on the whole, they're two very different groups. So the big developers of apartment buildings are not the big developers of single family. They require different land entitlement. They require different construction processes. They require different management post development and build. And so I don't think you can loop them all together and look at housing as one monolith, but there's very clearly demand for both single family and multifamily that is going to drive developers to build more supply.
This is one argument against more supply going forward. And I'd just like you to address this, please. This is from the FDIC website. This is showing, this is dated last quarter, but this is showing unrealized losses and gains on investment securities at banks. Okay. And now, according to data from the FDIC, the banks now hold the largest amount of unrealized losses on their books since 2008. In fact, considerably greater than the great financial crisis. So the argument here is that with so much bad debt on their books, they're unlikely to loan more to developers, construction companies, whatever the case may be. Liquidity may dry up for the housing sector, both commercial and residential. What do you make of this trend?
So that picture, which you're showing, as you know, they're bond securities. They're bond securities they bought with a yield of 2.5%, and they're completely underwater today because you can go out and buy that same security with a 6% yield on it, right? So the actual value of that bond is a massive loss, except for the fact that it's held to maturity. So they bought the bond with a 5-year life on it. They haven't had to go mark to market because they're not looking to sell it. And therefore, that loss never gets calculated in because they're holding it to maturity. Okay. If they needed to go sell it today, it gets marked to market and they take the loss. So they're going to hold those portfolios to maturity and they're not going to realize those losses unless they have to. And that's what ended up happening with SVB. And that's the reason that SVB, Silicon Valley Bank, went upside down. and went out of business. So that big negative dip that you have right there, it's there, it sits on their books, but guess what? They're still making off of that. Go back to the example I used, they're still making 2.5% off of it. Would they prefer to have that capital and have it invested in an instrument that's yielding them 6% today? 100%. But they can hold that to maturity and never realize that loss. It will get paid off when it comes to maturity, and they will have made 2.5% up until then. So right. I think your big question is there liquidity for banks to originate new loans? Yeah. And if you look at the earnings of Bank of America and Goldman Sachs just this morning, who are printing money, the quick answer to that would be yes. We were close to a banking crisis in May of 2023. Remember, May of 2023, it's not that long ago that many people were sitting there going, we need to change FDIC depository rules. We need to do a whole bunch of stuff to prop up the banking sector because it's going to go under. No one's talking about that today. Matter of fact, all people are talking about is the fact this morning on CNBC, Kramer was talking about the fact that Bank of America is wildly undervalued for the earnings that Bank of America has consistently been able to put up. So there's a very different view of the banking system today than there was just, 16 months ago. And I think you are going to see banks start to put credit back out for construction loans on single family and on multifamily. And I think that move of capital to the asset class, what that capital flow does is it brings down cap rates, which brings up values. So as you bring capital to it, the values go up, cap rates come down. And we will see that over the next 2 to 3 years.
Talked about office space. What about retail space? Are you concerned about small businesses going under the current macro conditions, and so vacancies for retail space going up? Is that happening?
Retail as it relates to retail sales, as in Target and Allbirds.
I'm thinking more like leases on small businesses, for example.
Yeah. Well, so you want to talk office, not retail.
Okay. Yeah. You're right.
Okay. So on the office side, look, as we talked about previously, I think there's going to be a resurgence of back to office. I think that you're going to see people going back. If you own a B or C class office building, I really don't know what the future looks like. It's going to be challenging. They're not going to be tenants who are lining up to go take that space. If you have an A class office building, there are tenants out the door for your space right now. So A class is doing really, really well because those companies that are investing in office know that there is a competitive differentiator between people who want to go be in an office that's wonderful space and people who don't go into an office that's wonderful space. It's part of the competitive landscape today. If we switch to retail sales continue to grow at an incredible rate. And one of the things that people, I think, forget is that U.S. GDP growth and U.S. retail sales have continuously outstripped the rest of the developed world for one major reason: Fannie Mae and Freddie Mac. We have the most sophisticated secondary mortgage market in the world. And because banks like Bank of America can originate a mortgage and sell it to Fannie Mae or Freddie Mac and then recycle that capital to go back and make another loan, and those loans to Fannie Mae and Freddie Mac have been long-term fixed rate mortgages, while people who live in the UK and live in Japan have floating rate loans on their homes that have been strangling them since we've gotten into this higher interest rate environment. In the United States, 80% of homeowners have a fixed rate mortgage under 5%. That has meant that their cost of ownership has not changed at all as interest rates have gone up, which has allowed them to continue to go and shop at Target. And that is the reason why GDP growth has outstripped the rest of the developed world. And people don't get that. They don't see the connectivity to the fact that our housing ecosystem has the secondary market of Fannie and Freddie. They've allowed people to have long-term 30-year fixed rate mortgages. 80% of homeowners have a fixed rate mortgage under 5%. And that has then allowed for cash flow to be there for people to continue to go out and shop at restaurants, buy a pair of sneakers, and go to Target. And that has been a huge piece to this recovery that has not been talked about very often. And it's a fundamental piece to why our economy is held up so strong.
Final question, 30-year mortgage rates. The average right now I'm looking at is 6.08%. It's come down a bit since a year and a half ago. Do you expect it to continue following the Fed funds rate much lower, which is to say that the CME Fed Watch was predicting, I think, another 100 basis points to 150 by next year of a cut? Do you think that the 30-year will follow that and drop by another 150 basis points?
I don't think the 30-year drops by 150 basis points. I think go back to what I said previously, which is just that we got to get back to a normalized yield curve. So if you've got a normalized yield curve, you got to first figure out where you pin inflation. Okay. So is inflation going to be 1.5%, 2%, or 2.5%? Depending on what you believe as it relates to what the target is for the Fed, because there are lots of people who think that the Fed will get to 2.5 and say, we're fine here. There are other people who said, no, they got to get to 2. And there are other people who say it's going to go to 1.5 because there's no inflation in the system other than housing. But whatever the number is there, you're going to have a Fed funds rate, which should be somewhere between 75 and 100 basis points above inflation. So if you're at 2, you should have a 2.75 or a 3% Fed funds rate. And then your 10-year bond should be somewhere between 100 and 150 basis points above your Fed funds rate. So if you get inflation to 2, you should be having a 10-year between 4 and 450. And your 30-year mortgage rate should be a little bit above that. So I don't think that you see a 30-year fixed rate mortgage I clearly don't believe you're going to get below 5% on it. I think it should sit somewhere between 5 and 6%. If you got back to that, that's a very healthy interest rate for single family housing. The problem, going back to what we talked about previously, is there are millions of Americans who have a 30-year fixed rate mortgage that is at 3.5%. So to get them to go and move from their existing house and put it on the market and give up that 30-year fixed rate mortgage at 3.5% and go buy a new home, which is going to put a 5.5% mortgage on it, that's a lot of money. You've got to make up for that delta. And so until that gets changed by either housing prices coming down or interest rates coming down more than I project they're going to, you're going to have a lot of trapped homeowners who don't want to move out of their homes. And that's their decision. That's their choice, right? I mean, it's a free market. They can either take on the additional cost or they can just sit on what they have. But fortunately, they can sit on it. And fortunately, their cost of home ownership has not gone up one iota because they've got a 30-year fixed rate mortgage.
Bottom line, to sum up, of all the different segments that we've talked about today, office space, retail, multifamily, and single family, which of these segments do you expect to move the most in terms of value in the next year?
In the next year?
Yeah, let's just do 12 months post-election. Actually, does it really matter who wins the election?
No, doesn't really matter.
Okay.
Study after study. I mean, you look, it doesn't really matter. Study after study shows that GDP growth will vary 10 to 20 basis points.
Mm-hmm.
So if you think the economy is going to grow at 2.5%, it might grow at 2.4 or 2.6, but it ain't going to make that much difference there. The one thing, David, that will make a difference is if one party sweeps. So if one party wins the House, the Senate, and the White House, there will be massive legislation that will go one way or the other. But barring that, whether it's a Republican White House and a Democratic Senate or vice versa, doesn't make that much difference.
So base case scenario, yeah.
Basically, and then the only other thing that I would put out there is that Trump's tariffs are very, very concerning. I think there's an underlying feeling that Trump would be pro-growth, pro-business. You look at the consumer confidence numbers when Donald Trump was last president, off the charts. There's a je ne sais quoi that President Trump has with consumers, with the Americans, that says that he's great with the economy and will do great things for their back pocket. The data would tell you that's actually not the case, but he has won the image contest running away. Consumer confidence numbers in 2019, Biden at his best moment has not even gotten close to it. So there's something there as far as consumer confidence jumping in to make a difference in overall GDP growth in the economy. I don't discount that one bit. But over the next year, it's hard for me to sort of say, over the next year, single family grows faster than multifamily. I think the one thing I would say on all this, David, is location, location, location. Real estate is about location. It's not a monolith. So the best market for multifamily over the last year, 2023, if you owned an asset in Columbus, Ohio, your rents went up and your value went up significantly. Why? Because there's not been any new supply into Columbus, Ohio in a very long period of time. And the economy is doing well in Columbus, Ohio. So The values in Columbus, Ohio went up. If you own an asset in Austin, Texas, where there's massive supply of new multifamily units, your rents are down and your value is down. But if you said to me, bet on one of those two economies over the next 5 to 10 years to either buy a single family home or or rent an apartment building or build an apartment building, I'd go to Austin all day over Columbus, Ohio. No insult to people who live in Columbus, Ohio. It just doesn't have the growth drivers that Austin, Texas does. So Yeah, go ahead, David.
Yeah, the one final issue is on policies, Trump versus Harris, immigration. Would that have a significant impact either way on the demand for housing? If Trump, let's say, wants to curtail immigration and Kamala is looser on immigration, how much difference are we looking at in terms of demand?
It's a really good question, and one that is extremely hard to size, only because those people, as I said previously, aren't showing up on rent rolls. So if they're doubling up and tripling up in housing, it's not spurring new housing demand. But if you think that there is a shadow market that is a lot of people who are not legal citizens of the United States renting and buying homes, that has a big impact if they either get deported back to their home of origin, or if they stay here and then start to buy or start to rent more, both single family and multifamily. It's a hard one. The numbers are all over the place as it relates to what the actual number of illegal immigrants who've come into the country over the past several years are, but it's millions of people. We know that it's millions of people. And so, sure, that could have an impact on the housing market, as it relates to overall demand. And at the end of the day, what we really need to have is continued GDP growth, because that's going to drive everything. And the interesting thing on that one is if you go back and look historically, while the Republicans clearly have the messaging around them being more pro-business, if you look back at history, under Democratic presidents, the economy has actually done better, as it relates to GDP growth. But, at the end of the day, that's not going to be that much of a difference one way or the other, I don't believe. And the final thing on that is tax policy. There are clearly different approaches on tax policy, but lots of people have looked at the Biden-Harris proposals as it relates to the wealth tax, and they forget about the fact that for the last 3 budgets that President Biden has submitted, they had a wealth tax included in there. It just never got approved by Congress. So the idea has been out there for a long time. It's not like Kamala Harris has come out with some wealth tax and it's the first time it's come out. It's actually been in the budgets that President Biden has submitted for approval. The bottom line is it has zero chance of getting through Congress as long as the Democrats don't own the House and the Senate or control the House and the Senate. And it's unlikely they will, regardless of who wins, whether it's Trump or Harris.
Well, thank you, Willie. You've been very generous with your time. Where can we learn more about you and your company?
You can find plenty about Walker Dunlop out there at www.walkerdunlop.com. We're a publicly traded company, so you can go and put in the ticker WD and pull up all the information you might want to know about us from a publicly traded company standpoint. And like you, David, I have a webcast and I do it weekly with people both from commercial real estate and then more broadly kind of in leadership roles across the business landscape. And that's the Walker webcast. And it's all great. And I greatly appreciate you having me on today.
Appreciate your time. And I'll put the links down below so people can follow those links there. Thank you, Willie. We'll speak again soon.
Thanks, David. Appreciate it.
And thank you for watching. Don't forget to like and subscribe.